Imagine waking up one morning to see your portfolio cut in half, and realizing that the greed that drove you to invest is now the very thing destroying your wealth. This is the cycle every investor eventually faces. Today, we're going to uncover the dangerous pattern that repeats in every market boom and bust, and why understanding it could save your financial life. It's the intoxicating feeling that makes even the most cautious investor throw caution to the wind. Suddenly, the world seems to have endless money, endless opportunities, and endless growth. Think back to the late 1990s during the dot-com bubble. Everyone believed technology stocks would never fail. Pets.com, eToys, and dozens of other companies were skyrocketing. Investors didn't even care about profits. They were chasing the story. Sound familiar? Today, we see similar euphoria with AI stocks, cryptocurrencies, and even meme-driven assets. At this stage, the market charts look like a rocket, prices climbing steeply, almost vertically. People talk about never losing money in tech, or this is the new gold. Social media feeds are full of success stories, while warnings are drowned out by the noise of excitement. But here is the first red flag. Markets don't move in straight lines forever. History shows that euphoria is always followed by something else. Euphoria. After the initial surge, the cracks start to appear. Suddenly, earnings reports show losses. Growth slows. Maybe a company you thought was untouchable misses a target. And just like that, optimism begins to fade. Look at 2007-2008, right before the financial crisis. Housing prices had been climbing for years, fueled by easy credit and speculative investing. People believed real estate could only go up. Banks were handing out loans to anyone with a pulse. The euphoria was at a peak. And then reality hit. Foreclosures surged, mortgage-backed securities collapsed, and the market plunged. This is the tipping point. The market shifts from irrational optimism to rational fear, often faster than anyone expects. And this is exactly what makes cycles so dangerous. You don't realize you're at the peak until the peak is already behind you. Fear. The market has reversed, and what was once climbing now falls sharply. This is where most investors panic. They see losses on their screens and start asking questions. Should I sell? Was I wrong? Let's take Bitcoin in 2017 as an example. Prices skyrocketed from under $1,000 at the beginning of the year to nearly $20,000 by December. Then, within weeks, it lost over half its value. Panic selling spread like wildfire. The same thing happened with tech stocks during the dot-com crash and with housing in 2008. Charts at this stage often show dramatic spikes, followed by equally dramatic drops. It's not just a dip. It's a psychological and financial shockwave that affects everyone. And here's the psychological trap. Fear is contagious. When everyone starts selling, it pushes prices down even further, creating a self-fulfilling prophecy of decline. Financial cycles are not random. They are human. They are driven by greed, fear, and herd behavior. From the tulip mania of the 1600s to the tech bubble of 2000, to today's speculative frenzy in AI and crypto, the pattern is the same. We can break the cycle down into 4 stages. 1. Euphoria. Prices surge. Everyone is optimistic. Risk is ignored. 2. Tipping point. Signs of trouble appear, but optimism clings. 3. Fear. Rapid sell-offs, panic, and loss of confidence. 4. Capitulation. Markets hit rock bottom, and only then does rational investing return. Notice something important. Most investors enter at stage 1 and panic in stage 3. The smart money? They often enter during stage 4, when fear has peaked and opportunities are abundant. Let's take a closer look at a few historical examples. Tulip mania, 1637. Prices for rare tulip bulbs reached astronomical levels, only to crash by 90% in weeks. People lost fortunes chasing a story. Dot-com bubble, 1999-2000. Technology stocks soared without profits. The Nasdaq lost nearly 80% from its peak. Many investors never recovered. 2008 housing crisis. Easy credit and speculation in real estate created a global financial disaster. Millions lost homes and jobs. Bitcoin 2017. A meteoric rise followed by a crushing fall, teaching the volatility of speculative assets. Across centuries, the pattern is identical. Markets move from euphoria to fear, almost like clockwork. And the emotional roller coaster catches everyone, from amateurs to professionals. Understanding the cycle is step one. But practical strategies are equally important. 1. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across sectors, geographies, and asset types. This reduces the risk of catastrophic losses. 2. Avoid chasing hype. If everyone is talking about it, be skeptical. High valuations often signal the peak of euphoria. 3. Set clear rules for selling. Decide ahead of time what triggers a sale. Avoid emotional decisions during fear-driven downturns. 4. Focus on value. Invest in assets that generate real profits and have sustainable business models. Warren Buffett calls this the margin of safety. 5. Prepare emotionally. Markets will always fluctuate. Recognize the emotional cycle and plan your moves calmly. Remember, the goal is not to predict the next crash, but to survive the inevitable cycle and thrive over the long term. Picture a mountain range. The climb to the peak is euphoric and exhausting. You see others climbing, smiling, and cheering. The view from the top is breathtaking, but the descent is treacherous. Fear sets in, and many stumble along the way. Only those who are prepared, with steady footing, will reach the valley safely, ready for the next climb. Financial charts look very similar. Sharp upward curves represent euphoria, sudden drops show fear, and stabilization at lower levels is the recovery phase. Learning to read these patterns is essential for survival. In 2025, markets are brimming with excitement over AI, cryptocurrencies, and tech innovations. Some sectors show valuations reminiscent of the dot-com era. Analysts are divided, but history suggests caution. The key question every investor must ask: are prices justified by real earnings and growth, or are we chasing a story? Because when the cycle turns, those who ignored fundamentals will face severe consequences. From euphoria to fear, the market cycle is inevitable. It doesn't matter how smart you are or how much you know. Emotional investing drives patterns that repeat across centuries. But understanding this cycle gives you power. Power to stay calm, power to make rational decisions, and power to survive where others fail. So, take a moment. Review your portfolio. Check your exposure. Ask yourself, am I chasing euphoria or investing in value? Because your future wealth may depend on it. If you found this video insightful, hit the like button, subscribe, and ring the bell. Share this with someone who's chasing the latest hype. It might save them from the next crash. And remember, markets will rise, they will fall. But your knowledge and preparation are your true advantages. Until next time, invest wisely, stay alert, and never underestimate the power of history.